everyone, and welcome to the week ahead. I'm Tony Nash. Today we're joined by Anne-Marie Baiynd and Albert Marko. Larry McDonald may join us a little bit later, but we're really just talking about kind of what's happening in markets this week. We had a big CPI print, and there's potentially a secular change there. We're talking about trading the Fed rate cuts and what's happening with the potential of rate cuts there, as well as Japan, the BOJ, and the yen carry trade. So Anne-Marie and Albert, thank you so much for taking your time. Hi, everyone. We've introduced new subscription tiers for CI Markets. More data, more insights, and more options. CI Markets uses the power of AI to help you make better trading and investment decisions. It's a perfect addition to your analysis toolbox. CI Markets Free is our first tier. It's absolutely free. No strings attached, and it does not require any credit card information. Next, we have offerings at $7.95, $14.95, and $24.95 per month. Each of these offerings includes different forecast assets for stocks, ETFs, commodities, and currencies. Go to completeintel.com to find out more and subscribe. Hope you'll join us soon. We were just before we started, you were talking about this morning trading in markets, and Albert has sent a tweet out saying, hey, buy this dip as things fell. Can you talk us through what you're thinking there? Like, why are you thinking that it's a time to buy this, and what's going into that calculus?
Well, I mean, it's no surprise that I'm very vocal about an election rally and whatnot in the markets, just simply because Yellen and Powell has shown over and over again, the same script of, they can crush oil, they can crush VIX, they can surge tech in that time, they can pump the bond market. I think the bonds were at like 115, almost 114. It's, getting down there at like, the level of where the abyss would be. But they can certainly pump, and they have, with all the bad news and fake Iranian attacks on Israel impending today, they still haven't broken 5180. It's just held strong, and they keep dangling us over the edge, but realistically it's just pretty strong. It's a pretty strong level at the moment from what I see.
Okay,
what do you think the bond market is telling us with I watched the TLT, and it's been sitting in this big fat channel for a really long time, and it fell out. Now it's trying to get back in. And a lot of people are saying that the bond market is sussing out something. But what do you think? I see a big cross current there. So what do you think they're positioning for?
The only part of the bond market I watch is the long end. And it's because I know that Fed and Yellen and her friends buy it all when they have to.
Yes.
So, and like I said earlier, 114 and below that, you got real problems in the market. I mean, you can't go much lower without equities suffering. So whenever we get to these, line in the sand, I would say, you see the bond market pumped 1-2 points over and over again. Yeah. Just go look at the charts over and over again every single time, every week.
Yeah. So we're in a rinse and repeat.
It's worked for the last 2 years. Why would they change?
Yeah.
Rinse and repeat until when?
We have no business being at 5,300 with only 7 stocks in tech industry surging us. We have no business being there. I mean, the Russell is at 2,000 or like 2,100 or just around there right now. It's like, I haven't looked at it, but I mean, back, what was it, like a year and a half ago, or at the same spot. And it hasn't done anything.
So when you say no business being there, what do you mean? Why?
Yeah.
What in the economy tells you that we should be at 5,300? If you take away the Mag 7 stocks, what do we have left? Like 50% of the stocks negative? I mean, how does that make sense fundamentally?
Well, but Greg Ip tells us that we're too stupid to understand the economic information. So maybe things are just better than we're aware of.
No, because they're using inflation to pump the earnings numbers. Those aren't real figures. When those things start getting revised, like you always say, and the job numbers start getting revised, like it always happens, and then what are we left? We're like, oh yeah, well, we had a crappy couple quarters, but that was 2 quarters ago. Looking ahead.
Right. So Just to go back to a conversation we've had several times, it's part of the reason that markets want inflation to pump is so that companies can continue to expand their margins. They can continue to raise prices based on inflation expectations. And when that happens, they continue to raise their margins because consumers are prepared and businesses are prepared to pay higher prices, right? So, we saw a Michigan survey out this morning, and I know it's easy to push that aside, but we've heard Fed officials say that they take Michigan into account. So consumers expect inflation to be higher, and consumer expectations are declining. So sentiment expectations are declining. So, I don't really have, I guess, a hypothesis as to whether we're going a lot higher or a lot lower. But when you say we have no business at these levels, I just think that's a really interesting statement to make.
Well, we don't have a fundamental market, so what does it matter?
Right.
Exactly.
Yeah. But we do have what oil has kind of flattened out a little bit, right?
Yeah, over the last 5 days.
It's up a little bit this morning, or yesterday, something. It was flattened out a little bit. Gold continues to rise, but gold, that's largely Asian money coming into gold as a hedge, right?
That's
right.
We
see the yen falling, we see CNY falling, and it's people in those countries saying, I need something. I can't count on the dollar. We're going to put money into gold. Is because I see a lot of people here say, we've got to move into gold as an inflation hedge. We see CPI numbers, and yeah, but it's not at 6 or 9% anymore, right? It's at 3.5 or something like that, 3.8 something. So it's not as if the sky is falling necessarily, although we're not seeing 2019 prices ever again. But the time to get in gold was 2 years ago, I guess, not right now. Like we're at the tail end of this, right?
Yeah, I mean, most of this gold surge has been driven by the Chinese, not so much the Japanese. The Japanese like buying dollars; they don't like buying gold in this situation. And the Chinese are using it to arbitrage for dollars that they're desperately starved of. So
right, yeah, and so the Chinese are trying not to go into dollars. They're trying to buy gold in order to avoid dollars for the kind of the optics of it, but also the safe haven status of it. Is that fair?
Yeah, that's fair.
Okay, Larry's just joined us. Larry, thank you so much for joining us. I know you've got a super busy day, and I appreciate this. So we're right in the middle of this conversation about gold. So we were just saying, hey, how long is this market strong in gold? We've talked about, Asian, largely Chinese, Japanese moving into gold markets. Anne-Marie, what is your thought about kind of the maturity of the gold play right now, and what are you watching?
So, it's still very, very bullish, but I take a look at how far something slips away from that 8 exponential moving average. And if it's really far away, which it appears to be about maybe 200 points away from it, it's good to take a breather. And when you see a ton of things moving through the Twitter feeds and that sort of stuff, when you think it might be the time to jump, it's really the space to go wait for the pullback, because most of us that are prudent, that have been long gold, once it broke out of its channel and kept over 2,000, we're feeding the ducks. Right? Mm-hmm. We're moving back to a core position size and saying, all right, let's just see what moves ahead from there. So price-wise, that's where I'm sitting.
Great. Larry, what are your thoughts on gold right now?
Well, the gold-silver ratio, so we run a Bloomberg chat with hedge funds, mutual funds, and pension funds in about 20 countries. And we kind of have a live ideas dinner every day. And not everybody contributes, but a lot of people just observe. But the last 3 or 4 days, people are talking about, how cheap silver is, and it broke a big technical level. I'm sure Anne-Marie saw that. And so, yeah. So in other words, what happens in cycles in all commodity bull markets. You look at Cameco and look at uranium, say 2020, 21. The mothership is the first mover. Everybody hides out in the mothership at the beginning of a bull market. That's either your large cap equity in Cameco or your commodity, right? Your actually uranium. Same thing with oil in 2020. Everybody moved in oil first, and then it was Exxon, then it was Chevron, and then it was Marathon, and all the way down. So as the bull market matures, and Anne-Marie's kind of getting into this, I completely agree. I think you want to be selling down gold and going to silver. The platinum gold ratio is mind-boggling. Your gold is the richest to platinum, literally, I think, in the last 20 years, as of like last week. And platinum's starting to pick up here. And all the gold ever mined in the history of humanity, everybody knows this. It's essentially fills up an Olympic swimming pool. But all the platinum ever mined would only go up to your ankles in that pool. I mean, so really? If you go into
you say everybody knows it, but I didn't know that, Larry. That's amazing.
Well, everybody knows the first part. No, but the first part, the Olympic swimming pool. But the ankle thing, not many people know. I'm sorry, but so we're at a stage here where if we're really at a stage where capital's moving, there's a migration from going from what we call financial assets, which are bonds and growth stocks. Everybody knows there's 21 trillion in the NASDAQ 100. There's about 35 trillion that's tied to passive indexes that are tied to the S&P and the NASDAQ. So, and it's more than that. And so essentially everybody's 401k on planet Earth, pretty much, in all Western civilization, is long, a handful of bonds and growth stocks. And in those growth stocks, it's like 10 to 15 stocks. So I think what's happening is, and Albert's been all over this, if there's a regime problem with the United States government, in terms of debt, sustainability, if inflation normalizes at 3% instead of 2%, then you're going to have probably a migration of assets and move into a whole host of other hard assets relative to gold and other things. I think the first stage is everybody hops into gold, and then I think we'll go into the second stage in the next year and a half, 2 years.
Okay, very interesting. Okay, let's take a step back and go back to our original plan. And Larry, you first of all, it's nice to have you on. Thank you very much. I didn't get to do a proper welcome since we we had kind of a warm start for you, but thanks for coming on. Marie, it's your second time on. We really appreciate this. And Albert, as always, we are grateful for you being on. So Larry, CPI, we had CPI this week, obviously a super important print. We'd heard Jerome Powell in one of his recent pressers say that he thought CPI he didn't use transitory, but kind of a temporary issue. And we could probably talk for hours about this. That and the JPY seem to be some of the big items of the week, but you had a great tweet out earlier this week looking at CPI and saying we're in a new world and a new normal. So I know that relates to your new book. So can you tell us a little bit more about what that means in terms of a new world and new normal?
Well, I'm going to say something. I have so much respect for Albert and the politics, and he's been a mentor to so many people. Really helps people understand what's happening, on the Hill, because he's spent a lot of time on the Hill, and I like to talk to people that spend time on the Hill. Our thesis in the book is that, listen, the 2008 financial crisis had a huge impact on the 2008 election. Obama was an incredible candidate, but if you're in that team Biden, all those people lived through that experience. So they know a financial crisis could really help Trump. And so I think what they've decided to do behind the scenes is, if you think about Lehman, the fiscal and monetary response in our book, we talk When Markets Speak is the book. But the fiscal and monetary response all into Lehman in those follow-on years was about 3 to 4 trillion. The fiscal and monetary response to Silicon Valley Bank, the banks, and then COVID is about 16 trillion. So what I think the Democrats have done, and I want to hear what Albert says, is why, you could say it's a wise move in some ways, where they're going all in on the fiscal and they're suppressing any possible chance of unemployment rising into the election, and they've got Powell and Yellen helping out to suppress this banking crisis that could have been really bad, but they expanded the balance sheet. They basically went all in, and all of that side effect of those actions is going to create a more sustainable inflation regime. But I think their bet is that a lot of that worst part of that will be after the election. So they want to kind of like, let's, four corners now, when you want to get, through the election and that's, I think, their game. I think they're more they want to suppress unemployment, and they really don't care so much about inflation, but they will use their pawns in the media to really try to gaslight the inflation story. There was a lot of gaslighting real time in 2021. And everybody got suckered in, and all those regional banks that blew up, they got suckered into gaslighting on Twitter and from the Fed around inflation. And so, in other words, if you're at Silicon Valley Bank and you're a risk manager, your duration was too long, right? So you believed in transitory inflation. You know what I mean? So those banks blew up because of gaslighting on inflation, right? Yeah. So, and lo and behold, guess what? As we head toward an election, we have similar gaslighting over the last couple of months. What they were doing in January is they were taking that 3-month run rate of inflation kind of coming down, and they were extrapolating it out 12 months. And they were saying, oh, Mr. and Mrs. Jones in Ohio, your grocery bill's up 30% over the last 4 years, 40, maybe 50%. But don't worry, because the data shows us that we're going to normalize, right? And so, and any party would do that. This is not about any party wants to stay in power, right? And they'll do certain things in an election cycle. I think that is what this is all about. But and that's one of the main parts of our book, our When Markets Speak.
So the new normal is just get used to prices being 30% higher. Not just, but that's one of the key components of it.
Yeah, in other words, inflation, the previous regime was inflation normalized from the last 20 years, multiple times between 1% and 2%. Mm-hmm. And we had the Brexit, we had austerity that Albert could talk about, in 2011, 12, mm-hmm. Massive austerity in Europe with a Brexit problem, and then with Greece, and in the United States with the Tea Party. So it was a massive austerity. Now we have, there's zero austerity in the world, and you've got this election coming up. And so you're going to have a new inflation regime at a higher level, so 3-4%. And if that's the case, there's trillions of dollars that's misallocated globally. Yeah. In essentially overloaded in financial assets versus hard assets.
Larry, it sounds like to me that it's not just, say, Biden; it's all incumbents who are trying to convey that message. It's 100% party. It's you look at the Republicans holding the House. They want to be able to say things are okay because they don't want to be voted out. Right?
Yeah, Democrats in the Senate, they want to. In a way, the summer of 2008, Bush in the summer of 2008, they were downplaying the financial crisis. I mean, right. And I remember following a lot of these Bush, real aggressive Bush people on Twitter, and they were just in complete denial. And I wish I kind of voted Republican most of my adult life, but I was kind of because I was a trader at Lehman. I wrote the book about Lehman, the crisis. And I was like, guys, I'm sorry. This is really a problem. This financial crisis in 2008. So you're right. They will downplay it into the election.
I remember seeing that first report on the likely impact of the housing crisis in 2007 or 8. They said the full impact would be $200 billion. The full impact. That was the early estimate.
Yeah. So, I never heard that stat. That's a great one.
Yeah, I think, and this will come as a surprise, I think it was a Deutsche Bank report. So,
yeah. So well placed. Somebody placed that. But
exactly.
That's once again, that's real-time gaslighting, right? It's not gaslighting looking backward. It's actually gaslighting at the moment it's happening.
Right. So there is a kind of I would say non-DC, non-financial markets belief potentially that the world will kind of return to normal, or a hope that the world will return to normal. Will that, how long will it take for that to be displaced, or we just wait until the next election and then it kind of dislodges?
Well, the last 100 years, we go back and forth between a unipolar world and a multipolar world. So 1968 to 81 was a much more multipolar world. We had Vietnam War, and a lot of times, Neil Ferguson said this in my book. Inflation in wartime it's a big contributor because of all. Just think about what's going to happen in a couple of years, right? We're going to have to rebuild the Ukraine, right? We have a copper crisis in the world. We've got a U.S. power grid that's, essentially 50 years old in some places. It's a $2 trillion rebuild to support artificial intelligence. So all these guys that you see on NVIDIA, all these analysts that are talking up this growth trajectory of artificial intelligence are just drinking the Kool-Aid. They're not looking at the power grid. So what's going to happen is we're going to overload the power grid with electric vehicles and with all this AI data centers. And I can get into the numbers, but they're just mind-boggling how much these are the biggest energy hogs in the world. You're talking about the amount of consumption from artificial intelligence alone in, say, 2026-7 is equivalent to France and Germany's consumption combined on the current growth projections, if you listen to these guys. And so, and then we're going to have to rebuild the Ukraine, right? So think of like how much copper, how much aluminum, the bottom line is we're going to be in a multipolar, higher inflation world probably for another 10 years before we go back to more of a unipolar, low inflation world.
Okay, very interesting. And then finally, in the near term, as we have this, I guess, transition or whatever into this kind of new normal world, what should investors be looking for in the near term? But then, what does that transition look like in the longer term? So, what should they be paying attention to now? But then, over time, when will you know that their attention should change, and to what should they change?
Well, one clue in the last 5 months is the performance of, say, the cash cows ETF versus cloud computing. So long duration equities, growth stocks, do great in disinflationary regimes, and they outperform. If you go into a sustained inflation regime, then all those DCF models, discounted cash flow, that all these portfolio managers use, they will start to want to own cash cows. And so, in other words, so the first clue that I see that this is a new world is if you look at a chart of the cash cows versus, it's like the cash cows are going up, and ARK and Cloud and Renaissance IPO, all these long duration equities are going south. But the NASDAQ has held up very well, even though there's a lot of growth stocks in there. But if you look at the tertiary long duration plays, the money's coming out. So that's kind of the first thing. The second thing, in the last, say, 8 to 12 weeks, we calculated there's about $1 trillion that went into oil and gas equities, uranium, gold, and silver. So your materials and your oil and gas picked up $1 trillion, which is a big number. I mean, the gold and silver alone, I think, picked up over $100 billion. So you're talking about a big move up in small pockets of little, assets that are underowned. And so if you just look at, say, the BCOM, Bloomberg Commodity Index, versus, say, the S&P, it's made a big move. If you look at gold versus the S&P, gold's now outperformed the S&P since 2018, which is kind of weird, right? And don't get me wrong, there's periods in there where gold underperformed, but since 2018 and since 2020, gold is outperforming. So I think those are the clues that we're kind of in the first inning of maybe a pretty substantial secular shift where, some of that 21 trillion on NASDAQ 100, probably, maybe 3 or 4 trillion that moves over to hard assets and, and commodities.
Right. Okay. And what would you consider a cash cow? Would a Meta be a cash cow? I know it's a technology play, but they throw off so much cash. Was that a cash cow too? In
the ETF, they have your big refiners, your Exxon, if you look at a chart, Exxon's at an all-time high today, and the regional bank index has been making, it's 35% off the highs. So there's something going on where that's what we get into the multipolar world thing. In a multipolar world, Exxon's at a new high, right? Think about that. New high today, all time, with the banks, because oil's breaking out, drones are striking ships, drones are striking refineries in Russia and ships in the Suez Canal. So you've got this multipolar world thing pushing up oil prices. That's pushing up rates. That's putting pressure on the banks, right? So the banks, the KBW index is 35% off the highs with Exxon at all-time highs. That tells you that's a 1980s, 1970s type situation. Like you don't really see that very often. You look back, right. when did that happen? I guess it might happen in the 70s, right? But that's the multipolar world indicator.
Yeah. Yep. Yep. Albert, I'd love to talk for hours about a multipolar world between you and Albert. I think that would be fun. I don't think we can get into it now, but it'd be great.
No, it's interesting because what are you saying about the bonds and rates and the banks and whatnot? You know, the Yellen and the Powell and the Biden administration, and like they have a double-edged sword here. They can't let bonds go lower because it affects the stock market. And, they're in a tight spot right now. It's like, what do you play right now? Keep equities up or solidify the entire economy? Obviously, like Larry said, is keep the market up for election optics. Mm.
Yeah. Okay. Speaking of rates, let's move on to Anne-Marie. Let's talk about rate cuts because there's been an expectation for quite a long time that we'll have, how many rate cuts in 24. We have the CME Fed Watch tool showing that there will be 2 rate cuts expected by end of the year. So it went from like 7 or something to 2. And we're hearing people say 1. I think there was a banking report out today saying there will be 1 in December, maybe something like that. So does that seem about right to you? First of all, 2 cuts. And I guess that's the first question.
Okay, so if I look at the statistics during election years, the Fed's normally super quiet about what they do in terms of, because they don't want to appear partisan. And so I think 1992 was maybe the last, if I'm remembering that stat, 1992 was the last time that they had a rate movement prior to the election time. And so if I look backwards and I go, near past might make for near future, then maybe we don't do anything, especially if things get a little hot. But then I started picking Albert's brain when we began speaking earlier, and he said, well, why don't you consider this on for size, that there is a fair possibility because both Yellen and Powell want to pull rates in, that we could see them in July or September. So my initial thought positioning, because I am really just a hardcore technical trader, and FYI, the gold futures, which I trade fairly actively, are like $70 lower than they were when we first started talking. So that's kind of interesting. It's still at yesterday's close, but it really spiked up there and faded. So in any case, getting back to that, my supposition was prepare for long sideways grinding action until something breaks. And when something breaks, whatever it is, then we're going to see the market scramble and move in one direction or another. So my initial thought was, hey, listen, they could do nothing, which I tend to think they might. But if they're forced to, and it is something small, like Albert says, I think we could see an outsized move by the market because, traders, the one thing we all have in spades is lack of patience. And so the second something happens, we're going to try to front run whatever that motion is. So do I think they're going to move? I had looked at past and went, they might do nothing. But if I think about, all right, if we're looking at optics for incumbents or whatever, and they do pull it back, I think we're going to see a fairly seismic move in the market because the underpinnings of what's got us holding these higher levels, I tend to sit on the side that Albert is sitting, saying there's general weakness in the place in the economy where the majority of motion and economy rising, that mid business is perhaps not as strong as everyone thinks it might be.
Okay.
I know that was a long answer.
You were thinking none before the election, but Albert swayed you to maybe two before the election.
Yeah, Albert swayed me to the space that,
hey,
you better prepare. You better prepare because I'm thinking, I'm right. Because, I'm always thinking, of course. Right. But I realized from that space, hey, you better think about how you're going to hedge that because I don't see us getting up over our recent highs. I see us being caught in this giant swath of sideways motion where everybody thinks, oh, we're going up, oh, we're going down. And then the squeeze comes and it moves us in those opposite directions.
Right. Albert, what are your thoughts? I know you have a lot of years in the Fed, so what's going on?
Anne Maria's right. It's like, they should not do anything. If it was a correct and fundamental market, they should sit on their hands and just wait for the election to be over.
Let me stop you there. I think that assertion right there is assuming the Fed is non-political or assuming the Fed tries to be seen as non-political. But we're in a world now where the Fed is actually political, right? We see people like Austin Goolsbee packed into the Fed, who is, he's a great stand-up comedian, but I really question his capabilities, right? And he's definitely hyper-partisan, right? And so, can the Fed be considered nonpartisan anymore? I think that's a potentially flawed assumption.
It's a very flawed assumption, in my opinion. I mean, I've talked to a lot of people in and out of there. It's a joke to say that. Yeah, and it's just like I said. Fundamentally, they should sit on their hands and not do anything and let things play out. Rates are high enough to where, it's holding down inflation. I mean, maybe depending on what numbers you look at, but a rate cut is just disastrous for inflation in the long run. But they don't care. I mean, it's just they want to cut, but they need a justification. So honestly, I would look towards April and May and June to see what kind of data comes out or what's happening in the markets that would justify them to say, oh, we need a rate cut now. So that's all I have to say about that. But Anne-Marie's
does it potentially come in the form of downward revised CPIs, and then we see some flat to negative CPIs in, say, April, May, and then they say, oh boy, it's time to cut. We've conquered inflation. Is it something like that?
Yeah, I mean, I would look for a oil crush, VIX crush, and say, demand's down, production, productivity's down, blah blah blah, whatever lies they want to spit out there. They can just to justify a cut, but you'd have to see something like that in the data that comes out. Otherwise, Anne-Marie's right. They shouldn't do anything.
Just trade the channel. Larry, what do you think?
Well, there's two ways to look at rate cuts, right? One is on a chalkboard with economic data. And the problem with economists is, they've spent their whole life, the Westchester Country Club, the cocktail parties, the finger sandwiches, and, and number one, and they really don't understand risk. Like they look at things from a prism. So all on Twitter and all these economists that put out the reports, they're all in the same cabal. And most times that's okay. In other words, most times traditional economic data will drive Fed policy. But there are a lot of times, I say 20% of the time, and I think we're in one of those times where look at what's happening now. Multipolar world, oil moving up aggressively. You've got the banks that are long a ton of commercial real estate that's mispriced. So the Fed suppressed rates for so long, right? They suppressed the cost of capital artificially for so long that all these banks are long tons and tons of horrible assets that are in hold to maturity portfolios. It's okay, right? And the Fed put out a new facility to help them work through it. But there's still, if oil goes up, because of a geopolitical rate spike with the 5 years up, the last like 8 weeks or so, maybe it's 12. It's up almost 100 bips. So 100 bip move on fives. You know what that does to the mortgage-backed portfolio, mortgage-backed securities and CMBS portfolios at these banks. So, and all across the banks, if you know, I was at Lehman, so I've been in these risk meetings. What they do is, if you have some assets, like we had leveraged loans at Lehman, and say your department's long these illiquid leveraged loans or commercial real estate, what they'll do for 1 or 2 quarters, the risk people will let you market. If you sell them hard, listen, we're going to get 100 bips of cuts. Okay, give me another quarter. And this is what they do. And every single day you're in this, with oil moving up and rates moving up, those marks are getting worse and worse. And finally, you get the tap on the shoulder, and you have to puke it out. And then all of a sudden there's a real print. And we've seen that with Tokyo Marine recently, Aurora. These are banks around the world, PDD, that have been puking out commercial real estate. But the U.S. commercial banks, especially the super regionals, super regional banks, not commercial. I think the super regionals are the ones like Zions, Comerica. These are ones, U.S. Bancorp, with a lot of problems in this space. So in other words, 100 bips up in rates from here, another $20 in oil, that probably gets you maybe even 100 bips of cuts, right? So in other words, if oil were to break out $20 and rates and the Fed loses control of the long end, then they'll have to either cut or do QE to put out this banking crisis fire. But if the rate curve normalizes and inflation comes down, then all of this probably isn't much of a problem at all.
Maybe. Every time you say multipolar, Larry, every time you say multipolar, I smile because I know Albert's.
Well, he's not really, but Larry's not talking about multipolar in a military sense, which I always discuss. He's talking about a more economic sense, and nations plugging in vacuums that the U.S. has left. Well, that's what I understood, anyways. Because
great. Okay. Hey, Larry, you mentioned Tokyo Marine. So I want to talk about BOJ and JPY, excuse me, for a little while. So, obviously we've seen huge moves in JPY over the past few weeks. I wouldn't say it's in free fall, but it's certainly a mess. Ueda, the BOJ chair, was appointed about a year ago. He really hasn't shown himself to be the person to really steer Japan through uncertainty or have conviction. He seems to be losing credibility. BOJ seems to be losing credibility. People are looking to the Ministry of Finance for leadership, and they won't comment on it. So at some point, it seems that the BOJ has to take action to strengthen the yen, which could have a huge impact on global markets, of course. So, Albert, you did a piece a couple of weeks ago looking at the yen carry trade for Cloak and Dagger. So can you talk us through this a little bit? What does it look like? And how big of an impact would the yen carry trade have if JPY has to strengthen? So I know you said earlier that it's possible yen goes to 200. What do you see the likelihood of either side of that movement?
I do think that the yen's going to most likely drift up from here. I mean, I don't think that the BOJ has any willpower to strengthen the yen, and that's only because that they don't want to go against Yellen's orders. And this
so dollar yen drifting higher.
Yeah.
Okay.
I think it goes to 170, 175, 180. Maybe. I don't think it goes up to 200. I mean, it could. It really could go to 200, right? But I don't think that the BOJ, does anything to upset Yellen. And what she's doing is using the yen to pressure China, because of the yen being this low hurts Chinese, production. It's just, why would you get Chinese stuff when you can get higher quality Japanese stuff? That's just basic. That's the basic breakdown of it. And until Xi changes his ways, I don't see the BOJ, doing anything to strengthen the yen.
Well, one of the things that, and there's no I in team. So what I try to do is triangulate information from smart people, and I really work hard. Like when I have a problem, like in markets, and say something, the way markets work is, nobody cared about the yen maybe 9 months, a year ago, and now all of a sudden there's a period where for the last 2 weeks, people are every day. There's more and more people in the chat. There's higher level of conversation tone on this problem. And one of the things that people are watching for, and we saw this in 2015 a little bit, CNH vol. That's your volatility is measured on the CNH China, the yuan. And so that's been spiking. And there's a thesis in the chat from a couple of guys around like, okay, to Albert's point, Yellen's, I don't know if the White House, whoever's somebody, the Bank of Japan, that's definitely hurting China, right? So the weaker the yen is, it's stealing all kinds of trade balances from China. And so what does China do? People think they might do a deval again. And when they deval in 2015, the S&P dropped like 20%. It's very disruptive. It was crazy time. But what's fascinating about that, we looked at this in the chat this week. CNH vol was breaking out, exploding, and then like the VIX followed like for like 3 times during that period. So you want to watch CNH vol now and what's crazy is the CNH vol started to spike like within the last week or two, and now look at the VIX today. You know what I mean? Like, so there's some connectivity there.
Yeah, and especially Yellen was just there, right? So she goes publicly and she says, "Oh, we want China to stimulate faster." Well, you know what she told the Chinese privately? If you stimulate, you'll have financial repercussions. That's what she told the Chinese. So she's talking both, and that makes perfect sense with the VIX and the yuan sitting there surging like that. It coincided with Yellen's visit.
Interesting. So, our expectation for JPY is 160 by the end of the year. So not a huge fall through like you're talking about, Albert, but it's entirely possible. You said 175, I think. So
yeah,
awesome.
that would be just absolute chaos for the Chinese. 200, and then Xi is declaring war on Japan. I'm like,
think of how the problem is now. Think about how inflationary that is for Japan, and what does that do to their bond? To their bonds, right? So that would create a lot more inflation at home with a weaker yen. It would create a lot more, pressure on higher yields. That's where you get into this whole new yield regime. Because for many years, for the last 20 years, the JGBs, Japanese bonds, were like the global anchor of global yields. So the global anchor of global yields is giving way, and that's one thing. That's once again that you need a whole new portfolio, because in the previous regime, like 2010 to 2020, the Bank of Japan was your global yield anchor. You had disinflation. You had all these portfolio structures that worked. And now, if you're going into that new regime where that anchor's giving way and higher inflation, then you kind of want to be in a 1968 to 1980 type portfolio, and that's what When Markets Speak is all about.
Perfect. Very good.
Number 1 on Amazon right now. Number 1 in some of the financial categories. The best we got up into the top 100 books, but that for a short period of time. But we're going up against the fiction and all the James Pattersons and all those guys. So they're very tough to compete against.
Congratulations, Larry. That's really great, really. So in terms of CNY, our outlook is that we'll see a 7.45, 7.5 CNY by end of the year. So we're looking at deval in CNY and obviously deval in JPY. So that just creates a very competitive environment for East Asian exports, East Asian currencies. And it seems like one way to bring down inflation in the US in terms of the imports that we have from Asia, right? So is that part of Yellen's plan, Albert, is to push for deval in Asian currencies so that imports are cheaper to the US?
I don't know about that, right? I just think I don't know about that. I just think that she just wants to keep the inflows coming to the US and out of China. I mean, $3 trillion that should be in China stocks has gone to gold. Their bonds are terrible yield out there. Most of onshore China can't even buy overseas bonds or cash. They can only buy A shares and real estate. So, I mean, it makes sense that Yellen attacks that sector and hurts them, with the yen. So
Okay.
that's my thinking.
Okay, and so that obviously makes energy imports for China and Japan a lot more expensive as well, right? So we just saw an announcement, I think today or yesterday, that China is, I can't remember how many billions they're spending on new coal mines in China. So obviously those coal mines would power the EVs and other kind of green technologies that China's producing. So is that what they're looking for, is to use coal to power the EVs to avoid kind of oil and natural gas imports? Is that because there's 70-some% coal powered today? So it sounds like they're doubling down on that. They can't double down on it, but they're increasing it pretty dramatically so that they can have more coal powered EV activity.
It's cheap, and they can sell fuel on the market anyways at a profit. So I mean, the Sinopec has massive tanks all over Southeast Asia. I mean, they dump stuff right back onto the market whenever oil spikes. I know this firsthand because I deal in oil sometimes.
Yep. Okay, so that currency deval, you don't think that it's a short-term deal? You don't think BOJ is going to come back and intervene to make it stronger anytime soon?
No, absolutely not.
Anne-Marie, does that make sense to you?
Yes, but more importantly, just the outlining of all the things that Albert has spoken about, all the things that Larry's spoken about, it really adds more credence to this notion I have that because the knot is so Gordian, everybody's positioning and then waiting for the chips to fall because there are so many different places that we can point across a timeline that says, if this breaks, then we're going to have, and then everything is going to sort of mushroom on itself. And nobody knows quite where any of that is going to go. We just have, here's the biggest thing that I read, and I thought, you know what? That makes so much sense to me, is wherever the cracks finally open for the fissures to break, it's going to be in spaces where we go, yeah, I'm not really sure how to put that one on my bingo card. That makes us look at all the pieces and go, the raw price action is telling me that a lot of very smart people are seeing all the different ways it can go. But because there's nothing definitively saying, okay, that's where that's going, all the positioning stays in that spot that just keeps us going, well, I'm just going to sit on my hands and wait until I really see some cracks showing up, and then I'm going to go heavier.
But what if those cracks are already pretty obvious? Like commercial real estate, obviously, huge crack, right?
Well, I mean, we've been talking about commercial real estate for two years about having trouble. And now, yes, there's going to be some duration events that are going to occur as things roll on, but some of the super regionals are going to have a problem with that. Of course, we know localized and regional banks are the ones who carry the biggest amounts of commercial real estate on their books. Yeah. And yes, but we'll wait and we'll wait and we'll wait. And here's, a lot of investors lose a ton of money hedging for things that never happen. And I think the longer we move, the more people go, I mean, how much more insurance am I going to waste? And they'll pull all of it off. And when things look absolutely like it's going to be rosy, let's go out to the beach,
that's when it happens.
Some kind of bomb is going to drop out of the sky. And I mean that figuratively, not literally, although, that might happen too. But that's really, I think we think, it's obvious. And a lot of folks thought, hey, recession is obvious last year. And so they waited. And now we've got all kinds of money still chasing into the market, which gives us this incredible pervasive forbid that we see things get run down and then all of a sudden, people buy that 20 EMA or they do whatever it is because they're still in this, either the Fed bails us out or there's enough money on the sidelines to rotate back into the market that they're going to come in and hold these lows.
Yeah, but what I see is there are a number of obvious problems right now, right? But I think what the Fed and the Treasury have done very successfully is slow down the impact of those problems so that we don't necessarily see the follow through. They've done that in a genius manner. And it's easy to say the Fed is terrible. It's easy to say Yellen's terrible. But, we've been talking about commercial real estate for a year and a half, 2 years. Have markets tanked? No. Would they have tanked 10, 15 years ago? I'm pretty sure they would have, right? So we can fault these institutions as much as we want, but those super regional banks, they're still in business, right?
Exactly.
Equity markets still doing pretty well. The dollar still pretty good, right? And so they've done such a great job of slowing down the impact of these things that it kind of becomes a so what thing, or kind of a, I can't believe that that's happened and we haven't had a washout because of it. That's what I keep saying to myself. And that's why I think we keep seeing these recession calls where people are like, oh, X has happened, so a recession is coming. But the Fed and the Treasury have done such a genius job of slowing down the impact of those things, waiting for it to turn around. Is that fair?
Or we're just performing in spite of them. You can sit on either side of that, essentially, right?
Yeah.
One thing that I would say is a lot of people don't understand this because it's a bond thing, but say you have $1 trillion of bonds, right, of treasuries, and they're in 6-month treasuries. Those bonds, no matter what happens in the world, geopolitics, oil, higher rates, that $1 trillion of bonds isn't going to move in price because it's a 3-month or a 6-month treasury. But if it's a 10-year or a 30-year, Apple issued a bond in the last couple of years. I think about like 21. The CFO of Apple is probably the best bond seller in the history of the planet Earth. He sold, over 10 billion of paper at very low rates. Those bonds are trading in the 50s now, right? So think of what probably 50, 55 cents, 63 cents. That's bond backed by Apple. That shows you how much pain there is out there in long duration, right? Yeah. So it's really simple for everybody to understand. Yeah. So what Yellen has done, and this is, it's mind-boggling, scary, risky. It's a brilliant political strategy in some ways, but she basically, instead of issuing across the curve the way Treasury always has, she's piled into the front end. So over the last year and a half, they had to borrow, over $10 trillion, right? And they issued so much paper on the front end. So in other words, if she had issued long duration paper in size, those bonds would have been out there, and those bonds would have been down a lot, right? When that bond volatility would have been out there too, right? So every time rates go up, down, something in the Middle East, oil, those bonds, that $1 trillion of bonds would have been moving like this, right? Mm-hmm. And so that would have created, to Anne Marie's point, and to your point, Tony, that would have created a lot more problem in the market in an election year. But what she's done is she's gone all in, like massive, like 60, 70% of issuance is really in that front end to suppress volatility in an election year. But then here's the scary thing for, like, once they get through the election, all that's going to have to be refied. So if inflation is sustainable up here and rates are really at a higher plane, then all of a sudden that short-term paper is going to have to be refied across the curve. And that's where you get, it could be a very expensive thing for Treasury, right? And for the taxpayer. That's
either a second term issue or the next president's issue, right?
Exactly. It's after November of 2024.
That's a great place to end this, guys. Thank you so much. This has been an amazing conversation. I've really enjoyed it. Thank you so much, Larry. I really appreciate you taking the time. I know you get everyone's ear and you can be anywhere you want. And I'm so grateful you were here. Anne Marie, same with you. I'm so grateful for your time. And Albert, thanks again, as always. Thank you, guys. Have a great weekend.
Anne Marie, Albert, thank you. Thank you, Tony.
Bye.
Okay, bye-bye.